Hi there, my name is Randy Helm, and today we're going to do a quick overview of the big three financial statements: the balance sheet, the income statement, the statement of cash flows. Now, I have some other videos that will go into each of these reports in more detail, but today we're just going to do an overview, sort of a flyby. And after this video, I hope that you see how nicely they all fit together. So if you're ready, let's begin. There are several reports that come out of the accounting system, but the three we'll cover today are the main ones, the big three. They are the balance sheet, the income statement, and the statement of cash flows. As transactions are posted in the accounting software, they are posted to general ledger accounts, or GL accounts. Some GL accounts are considered balance sheet accounts, and some are income statement accounts. Let's look at the balance sheet. The purpose of the balance sheet is to report on the amount of assets that the company owns, the amount of debt that the company has, and how much is left over for the owners of the company. The information is as of a point in time, a specific date. It does not indicate how much has changed during the year. This section shows the assets. This is the stuff that the company owns. This section shows our liabilities. This is what the company owes to other companies or to the government or someone else. And this section shows our owner's equity section. Hypothetically, if we were to sell off all the assets for the amount shown on the balance sheet and then pay off all the liabilities, that remaining amount goes to the owners. This is what this section shows. While the section is impacted by direct transactions with the owners, it is mostly impacted by the company's earnings and losses. Now back to the assets section. This section is a summary of different GL accounts that were used to record the purchase of certain stuff for the company. For instance, when the company buys fixed assets, such as a walk-in cooler, it gets posted to an account in the assets section. When someone pays the company cash for some product or service, the cash part of that transaction gets reported here in the cash account. If you have a bar, your daily cash receipts will go here. If you run a beauty salon, those receipts will also go here. But when you spend money for supplies, it comes out of here. If the company takes out a loan from the bank, that bank debt gets reported in the liability section. Also, if the company has an open line of credit, that is also reported in this liability section. The equity section often has three main parts: the amount that the owners put into the company, the total profits and losses through the end of the prior year, and the total of the profits or losses from the current year. Each company may show this section a little differently. Part of those differences is based on the form of the company, whether it's a corporation, a partnership, a sole proprietorship. Another part of the difference is just style preference. Now let's take a look at the income statement. The purpose of the income statement is to report on how well the company is doing in its goal of making money. The various lines are summaries of general ledger accounts that were touched by transactions relating to income or expense. Every number here has one or more GL accounts behind it. This report shows the activity for a period of time, such as a year or a month, not just for one day. As I stated earlier, the balance sheet is just for the one day. Now the top part here is the revenue or sales for the company. After this, there might be multiple sections of expenses. Here we have a section showing the cost of goods sold. Here near the bottom is the income taxes, and the lines in between are the other expenses that the company had during the year. There are usually different subtotals to help the reader understand certain aspects of the business, such as gross profit and the total expenses. Different companies may show different groupings of expenses based on what is important to them. For instance, if you have a lot of employee-related expenses, such as wages, benefits, unemployment insurance, etc., you might have a section with all of this stuff in it and show a subtotal for it. The bottom of this report shows the net income or loss for the period represented by the report. In this case, it is a net loss of $14,000. Something I want to point out is that this number gets reflected on the balance sheet. Let me show you where. Next on the list of the big three reports is the statement of cash flows. This report helps the reader understand where cash is coming from and where it is going. There is a phrase I learned a long time ago: earnings are estimates, but cash is king. Sometimes the income statement doesn't show you enough information, and that's why we have this report. This first section tells us how much cash was generated or consumed in normal operations of the business. In this example, based on the operating section, this company had a cash decrease of about $25,000. The second section shows cash that was generated or consumed through investing activities. In this case, $32,000 was consumed through the purchase of fixed assets, which is sort of an investment. This third section shows financing activities. This would include transactions between the company and the bank, and between the company and the owners. You can see that bank debt was taken on during the year, and it generated about $93,000 in cash. The bottom of this report shows the total of all three sections and tells us the ending balance for cash for this company. Okay, so I have mentioned that transactions are posted in the balance sheet and in the income statement. But what about the statement of cash flows? Now, this may seem like a trick, but the amounts in this report are actually just coming from the balance sheet and the income statement. The top line is coming directly from the income statement. Then changes to the balance sheet accounts are used to come up with the adjustments. That is how this report relates to the other two reports. So each of these reports are related somehow to the others, but they each serve a different purpose. There will be videos that go into each of these reports in detail, so please stay tuned. This has been Managing Your Business by the Numbers. My name is Randy Helm. Thank you for watching this video. Be sure to look for new videos from me soon. If you liked what you saw, be sure to subscribe to this channel and hit the notification bell so that you do not miss out on any new material. Also, please leave a comment down below if there is a topic you would like me to cover. Until next time, have a good day.